Every generation believes it is living through unprecedented times. New technologies, new politics, new crises, new narratives. And yet books that study economic cycles open with a quiet provocation. The future rarely surprises those who understand the past. What changes are the costumes. What remains are the rhythms. Books that attempt to predict the future rarely claim certainty. In fact, the most serious ones are cautious to the point of discomfort. They do not forecast dates or numbers. They describe patterns. They explain why booms feel permanent, why busts feel sudden, and why both emotions are wrong in predictable ways. The word predict in these books is almost ironic. What they offer is not prophecy but preparation. The first lesson these books teach is that economies move in cycles not because people are irrational, but because they are consistently human. Optimism expands during growth, risk tolerance rises, leverage increases, standards loosen. Then, quietly, fragility accumulates beneath the surface. When something small breaks, everything large reprices. The cycle turns, not because of one event, but because conditions were already ripe. Books on economic cycles often begin by dismantling the myth of linear progress. Growth is not a straight line. Stability is not permanent. Decline is not failure. Cycles exist because systems overshoot and correct. Expansion plants the seeds of contraction. Contraction clears the ground for renewal. This is not a flaw of capitalism or human organization. It is a feature of complex systems. One of the most powerful insights repeated across these books is that cycles are psychological before they are financial. Prices move last. Beliefs move first. Confidence, fear, greed, denial. These forces shape behavior long before data confirms anything. Economic Cycles books teach readers to watch sentiment as closely as statistics because emotions change direction before numbers do. Another recurring theme is debt. Credit expands opportunity early in a cycle and magnifies damage late in it. Books tracing cycles across centuries from empires to modern economies show the same pattern. Easy money encourages risk-taking. Risk-taking drives growth. Growth justifies more debt. Eventually, debt outpaces the ability to service it. The unwind feels sudden, but the buildup was gradual and visible to those looking for it. These books also emphasize time horizons. Short-term observers see chaos. Long-term observers see structure. Economic cycles often unfold over decades, not quarters. Generational cycles, such as debt supercycles, demographic shifts, and technological revolutions, move slowly enough to feel invisible while they are forming. Books that predict the future train readers to zoom out far enough to notice these slow forces at work. Another important lesson is humility. No book that truly understands cycles claims precision. Forecasts that sound confident tend to fail dramatically. Cycle-aware thinkers accept uncertainty as permanent. Instead of asking, "What will happen next?" they ask, "What tends to happen when conditions look like this?" This shift replaces prediction with probability. Books on cycles also highlight recurring blind spots. People anchor to recent experience. They assume tomorrow will resemble yesterday. After long expansions, risk feels unnecessary. After deep contractions, opportunity feels dangerous. These emotional extremes are where cycles do the most damage. Understanding cycles does not eliminate emotion, but it creates distance from it. Another key insight concerns policy. Governments and central banks influence cycles, but they do not eliminate them. Books show how interventions often delay pain rather than remove it. Stimulus extends expansions. Tightening accelerates contractions. These actions change timing and intensity, but not existence. Cycles adapt. They do not disappear. Technology appears frequently in these discussions. Each cycle feels unique because each era has its own innovations. Railroads, electricity, the internet, artificial intelligence. Books caution that technology changes how cycles express themselves, not whether they occur. Productivity booms still lead to speculation. Speculation still leads to mispricing. Mispricing still corrects. Another recurring lesson is that cycles create opportunity unevenly. Wealth is rarely created at peaks. It is preserved through peaks and deployed during recoveries. Books show that those who understood cycles were not necessarily bearish or bullish. They were prepared. They reduced exposure when risk was high. They increased exposure when fear was dominant. This required emotional discipline more than analytical brilliance. Economic cycle books also emphasize that timing exact tops and bottoms is nearly impossible. The goal is not precision, it is positioning, avoiding catastrophic exposure, maintaining liquidity, preserving optionality. These strategies do not make headlines, but they allow survival and participation across multiple cycles. Another insight that appears repeatedly is generational memory. People who lived through crises behave differently than those who did not. As memories fade, risk tolerance resets. This generational forgetting is one reason cycles repeat. Books argue that studying past cycles is a way to borrow memory you did not personally earn. As readers move deeper into these works, they notice a shift. The desire to predict fades. The desire to understand strengthens. Markets become less mysterious. Volatility becomes less personal. Economic news feels contextual rather than alarming. These books also redefine foresight. Predicting the future is less useful than recognizing when the present resembles past turning points. Patterns do not repeat perfectly, but they rhyme enough to matter. Cycle-aware thinkers listen for those rhymes. Over time, understanding cycles reshapes behavior. People save differently, invest differently, plan careers differently. They stop assuming good times will last forever or bad times will define everything. They build systems that can survive both, and this is where the story begins to narrow. Because once economic cycles are understood, not as random disasters, but as recurring phases of expansion and contraction driven by human behavior, the future feels less threatening. Not because it is predictable, but because it is familiar. The goal stops being to forecast exact outcomes and starts being to remain solvent, flexible, and psychologically steady as cycles unfold again and again, revealing opportunities and risks in rhythms that only appear chaotic to those who have never learned how to listen. Like learning to read weather patterns instead of demanding a perfect forecast, and realizing that economic cycles do not exist to be conquered, but to be navigated. In the second half of these books, the promise of prediction fades completely, replaced by something far more useful: orientation. Authors make it clear that understanding cycles does not grant foresight in the cinematic sense. It grants context, and context changes behavior before outcomes change. One of the most consistent conclusions across cycle-focused literature is this: people are rarely ruined by recessions themselves, but by decisions made near the end of expansions. Overconfidence peaks quietly. Standards slip subtly. Risk that once felt unacceptable becomes normalized. By the time contraction arrives, the damage has already been done. Cycle-aware readers learn to recognize this shift, not through headlines, but through behavior, easy leverage, casual speculation, and narratives that dismiss caution as outdated. These books also stress that cycles punish certainty more than ignorance. Investors and policymakers who believe they have outgrown history tend to repeat it most precisely. Humility becomes a form of insurance. The willingness to say, "I don't know," keeps exposure reasonable. The refusal to overcommit preserves options. Understanding cycles is less about having answers and more about avoiding irreversible mistakes. Another powerful insight is the distinction between volatility and risk. Volatility is movement. Risk is fragility. Cycles increase volatility, but fragility is what determines damage. Books emphasize designing financial lives that can tolerate movement without forcing decisions. Liquidity diversification and conservative assumptions are not defensive pessimism. They are the admission fee for staying in the game. Cycle-aware thinkers also separate signal from noise. Not every slowdown is a recession. Not every rally is a recovery. These books train readers to ignore calendar-based predictions and focus on structural indicators, debt levels, demographics, productivity incentives. This perspective reduces reactionary behavior. It replaces urgency with patience. Another theme emerges around time compression. In expansions, time feels abundant. In contractions, it feels scarce. Decisions that could have been made gradually must suddenly be made under pressure. Understanding cycles encourages front-loading preparation saving during good times, simplifying obligations, and keeping fixed costs low so that bad times do not demand heroics. These books also address a subtle psychological trap, the belief that cycles are only relevant to investors. In reality, careers, businesses, and governments all move cyclically. Hiring booms and freezes. Credit expands and tightens. Opportunities appear and disappear. Cycle awareness improves career decisions just as much as portfolio decisions. It teaches when to take risk and when to preserve stability. Another recurring lesson is that cycles reward adaptability, not rigidity. Strategies that work across multiple environments outperform those optimized for one. Books show that the most resilient individuals were willing to adjust pace without abandoning direction. They slowed down without quitting. They waited without freezing. They acted when fear was widespread, not when confidence was universal. Importantly, these books reject fatalism. Cycles do not imply helplessness. They imply preparation. Understanding cycles does not mean sitting on the sidelines indefinitely. It means participating with structure. Exposure sized for uncertainty. Expectations calibrated for reality. Plans that assume disruption rather than perfection. As the narrative approaches its conclusion, authors converge on a final clarity. The true value of understanding economic cycles is not prediction, but emotional regulation. When downturns arrive, cycle-aware individuals are less shocked. When recoveries begin, they are less skeptical. They recognize phases. They respond proportionally. This steadiness compounds over a lifetime, and so the lesson resolves quietly. Books that predict the future rarely do so accurately. Books that explain cycles do something better. They reduce surprise. They protect judgment. They keep people solvent, flexible, and engaged, while others oscillate between euphoria and despair. Understanding cycles does not make the future controllable. It makes it survivable and often navigable with advantage. If this reflection resonated with you, pause and ask yourself one question. Are your current financial decisions built to thrive only if conditions stay favorable, or to endure if they change abruptly? That answer reveals whether you are betting on a forecast or preparing for a cycle. Share what shifted for you. And if you want to keep exploring books and ideas that replace prediction with preparation and fear with context, subscribe and stay connected. Because the future does not reward those who guess best, it rewards those who remain standing long enough to adapt.